Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Adam Ryan, manager of the BlackRock Income Strategies Trust. Hello, Adam.
Afternoon.
So this is a new trust. It's a new trust with a new name, although it used to be British Assets Trust. And rather than just a name change, the reason why I'm calling it a new trust is because pretty much all holdings have changed as well. What's happened?
It's interesting, isn't it? Because it's a new trust and yet it's been around for over 100 years. And I think it's fair to say that the board were thinking about their relevance as a trust going back 12 to 18 months. They'd actually done some work about its relevance in the marketplace, speaking to their shareholders, seeing why the shareholders owned the trust in the first place. So I think it's fair to say there was already a seed planted that something different should happen. And then along came the pension reforms and this idea that we need to be creating solutions for people who are entering retirement, need a higher level of yield, but aren't willing to take full equity market risk, which is clearly what British Assets Trust had, being by and large almost fully invested in equities. So I think those seeds were sown. The political landscape changed as it came into being in terms of not requiring to take a full annuity. So I think a number of these things aligned where the board thought, hang on a minute, we've got a window of opportunity to suddenly make British Assets Trust as was more relevant to today's savings environment and the pensions environment. Hence the transition to BlackRock Income Strategies Trust and a move away from just purely equities to be much more multi-asset focused, if you like, embrace the full toolkit that we as investors have at our disposal now, with the aim of really still seeking that income, which is what existing shareholders wanted, but to try and reduce the level of risk. And by doing that, hopefully attract new shareholders who, as I say, are in that period of their retirement cycle where they don't want to take full equity risk, but they still want to have some capital growth. They need that income, and therefore that multi-asset approach, that reduction of risk, will hopefully make sense to them.
It's a big change to go from domestic equities to basically the world is your oyster in terms of all assets, all geographies. In a way, it's easier to run a multi-asset fund because you have more choice in order to deliver returns. But in many ways, it's much harder because the pool that you're fishing in is considerably larger. So where are you finding the best opportunities? Yeah,
it's interesting. And there's always a temptation when you've got so much in front of you to be very magpie-like and just focus on the latest hot topic. And one of my colleagues has got this great phrase of the risk of being an investment tourist, where you just go to the latest hot destination. And there are plenty of those in today's investment environment. So you're right that we have to be very disciplined, and the research team that we've got, their focus is on a disciplined and rigorous approach to various parts of the asset markets, making sure we're evaluating these opportunities consistently through time. So in terms of where we've restructured, we've reduced the focus on the UK. And I think that shouldn't be interpreted as us being incredibly negative around the UK. I think the economic outlook was pretty good. Having a Conservative majority means that there'll still be a focus on corporates playing a big role in the UK economy. So I think all of that is good. But in order to free up money within the trust to invest elsewhere, we've reduced the UK equity weighting. Some of that money has gone into places like Japan. I think Japan is a bit at risk of being classified as an investment tourist destination, but there are some good things going on there. RB's reforms are beginning to bite. We're beginning to see wages increase. Companies are more focused on shareholder value. They're increasing dividend payouts, for example. So I think some good things going on in Japan, notwithstanding it's done well. Europe, I think, is interesting. It had done well. So when we took over the trust, we put some money into Europe, both equities and bond markets. But we've got more to go there. We've seen European equities pull back literally in the last few weeks. Bond yields have risen quite substantially. So I think Europe may be a destination we put more money into because I think growth is picking up, albeit from very low levels. And the ECB's quantitative easing programme I still think has got a long way to run. And I really do think caps out bond yields, particularly for the likes of Italy and Spain. So those are the sort of things we're looking at, quite different from the existing trust. But I think people had said, isn't this too complicated for individual investors to own? I'd argue, to your point, actually, in some ways, conceptually, it's easier. You think about the landscape today from a growth perspective, the opportunities, and that's where you go. You're not forced simply to own UK equities because that's been your mandate. So I would argue it's almost more intuitive to do it this way than just focus on a single stock market.
Adam, thank you very much.
Welcome.
This is Emma Wall from Morningstar. Thank you for watching.